Chapter 11 in our study of introductory economics is all about our money system. In this chapter, we're going to take a look at what money is, the role that it plays in our economy, where our money gets its source of value from, the characteristics of a good money system, and we'll wrap it up by talking about the concept of the money supply. Hey, but before we get started, let's have some comedy, philosophy, and maybe a little bit of advice. Money, why do we need it? Well, it's been said it can buy you a house, but not a home. It can buy you a bed, but not sleep. It can buy you a book, but not knowledge. And it can buy you a clock, but not time. It can buy you a position, but not necessarily respect. It can buy you medicine, but not health. And closely related to that, it can buy you blood, but not life. And it has been said that it can buy you sex, but not love. So some advice for you. Money isn't everything. The best things in life can't be bought. So why do most of us destroy ourselves trying? Well, enough of the philosophy and the little bit of comedy. Let's move on to taking a deeper look at all the aspects of our money system. We really can, however, answer the question, why do we need money? And here's the reason for it. In advanced and specialized economies and societies, which we are, barter, the direct exchange of one set of goods or services for another, becomes far too difficult and time-consuming to be practical. Stop and think about all the things that you or your family purchases or needs to purchase on a daily or weekly basis. And to obtain those things, if you had to use a barter method of exchange, not only would our society, but our individual lives would grind to a halt or a very, very slow pace, and we'd be in a lot of trouble. So let's start with a working definition of what money really is. Money is anything that serves as a medium of exchange, a unit of account, and a store of value. Those three component parts of this definition are really important, and we're going to examine them a little bit closer. And the three parts meaning the medium of exchange, unit of account, and store of value. They are called the three uses of money. And let's take a look at the first one, medium of exchange. By this, we mean that money is used to determine value during the exchange of a good or service. The second use of money is as a unit of account. Money provides a means for comparing the values between goods. The third use of money is as a store of value. Money will keep its value if you decide to hold on to or store it instead of spending it. You can store it under your mattress or put it in a bank for later use. And I have a question here. Is this last point about a store of value true in these modern times, especially with societies that have modern, very fast-moving economies? The use of money as a store of value comes under a lot of pressure in modern economies when you consider the effects of inflation and deflation on a monetary system. We'll be looking at that in further detail in upcoming chapters. Now let's take a look at the three types of money that have been historically used by societies and where they get their value from. The first type of money is what we call commodity money. These are objects that have value in themselves and that are used as money. Some examples: crops, livestock, precious stones fall into this category. Not too many societies these days use commodity money, and certainly not any of the advanced societies with modern economies. And the reason for that is when you stop and think about the uses of money, and particularly that last use, the store of value, you see that commodity money begins to have some problems with that. For example, your crops or livestock don't last forever, only last for a certain period of time. And therefore, by default, there are probably a bad store of value over the long term. The second type of money that's historically been used is what we call representative money. And these are objects that have value because the holder can exchange these for something else of value. And I'm going to talk about two examples here: old-fashioned gold receipts and current-day debit cards, which I'm sure you're all familiar with. Let me start with old-fashioned gold receipts. A long time ago, people used to do a lot of transactions using gold, and some people had a lot of gold. And the people that had a fair amount of gold, what they would do is deposit their gold with either a merchant or one of the early banks. And the reason for that is, number one, it wasn't convenient to carry around large amounts of gold. It's kind of heavy and bulky and awkward. But also you would be subject to getting hijacked, if you will, by bandits. So they wanted to put it in a safe place. Merchants quite often had safes that gold could be stored in, and naturally with the development of banks, they provided the same type of function. And in return for depositing your gold with either a merchant or a bank, you'd probably be given a gold receipt. And these receipts came in different denominations, if you will. If you're not familiar with the word denomination, it means segmented amounts to represent the gold that you had deposited with the merchant or the bank. You would then be able to take these gold receipts. For example, if you were a farmer, after you've deposited your gold, take your gold receipts over to the general store to buy supplies that you might need, and the store owner would accept the gold receipts as payment or a money system. Today, debit cards really provide the same function. It represents money that you have in a bank, supposedly, or at least an account that you've set up with a bank, that you can present to a merchant to do a transaction. The third type of money is called fiat money. And this is the money system that most modern economies have, and we certainly have in the United States. Fiat money, currency, or what we call legal tender. And what this includes is paper, coins, and virtual money that have value because the government in question has decreed. And if you're not familiar with the word decreed, it means because the government has said so and will stand behind and deliver upon, decreed them as acceptable ways to pay debts, meaning accepting the paper, coins, and virtual money. Now, explaining this in depth is a rather lengthy explanation. It involves also telling you about how we evolved our money supply. I'm going to do that in the Course Resource Center, so don't miss my explanation of why fiat money exists, how it relates to our money supply and our economy, and also the details, the interesting details behind virtual money, the gold standard, and some misconceptions that people have about our money system. We'll look forward to seeing you there for that discussion. In that explanation and discussion that we'll have in the Course Resource Center over fiat money and our money system, I will talk about two key concepts that make fiat money work, and you need to keep these in mind. The first is that a fiat money system must be limited in supply and accurately represent the total value of an economy. The second key concept is that there must be a governing entity. For example, the Federal Reserve Bank, in our case, provides the central planning for our money system and aggressively controls the money supply that our fiat money is part of. Having looked at the uses of money and the types of money that have been historically used, it's now time we should look at the 6 characteristics of a good money system. And here's the first one. A good money system must be durable, or durability. The money system must withstand the physical wear of continually being used. If your money system is easily destroyed, it cannot be trusted as a store of value. And let me give you 2 examples. A few moments ago, I talked about commodity money and used crops and livestock to illustrate why commodity money is probably not characteristic of a good money system. And the reason for that is crops and livestock have a defined life period where they can be used, and therefore as they age they lose their usefulness as a store of value. But let's relate this idea to our fiat money system and think about the bills that we use in our money system. And most people call the bills paper money, but in reality, and you might not know this, is that our paper money is not made of paper. Stop and think about this for a second. If it was, and I'm sure you've done this, where if you had left a dollar bill in your pocket for your jeans, when you washed your jeans and you took your jeans out of the washer and put them on and stuck your hand in your pocket, if the bill was made of paper, you would have a handful of mush. But what happens is you pull the bill out and it looks all crisp and new. So it's not paper, it's actually made of the same material that your jeans are made out of. It's made out of denim or linen, and it's about 95 to, I believe, 98% denim or linen. And the reason we make our bills in our fiat money system out of that is so that it has the durability and can be trusted as a store of value. A second characteristic of a good money system is portability. You must be able to easily take it with you and transfer it. And when you consider our bills and our coins that we have today, or more importantly, debit cards that we use today to do a lot of transactions, I think you can see that our current fiat money system is a far better system from this characteristic standpoint than using a commodity item like a cow or a bushel of wheat, or for that matter, even carrying around gold. So our fiat money system is far more portable than other money systems. Next characteristic is divisibility. To be useful, a money system must be easily divided into smaller units of value. The next characteristic of a good money system is uniformity. A good money system must be able to be counted and measured accurately. And let me go back to our comparison here between a commodity money system and a fiat money system like the one we have. Take, for example, livestock, or take a specific example, a steer. They come in different sizes. So is a hind quarter from every steer measured and counted in terms of its value, weight, and what it provides, the same for every animal? And obviously it's not. It also places a great priority and pressure on the butcher, if you will, to make sure that things are portioned out equally and uniformly when working with a type of commodity money like that. However, on the other side, fiat money, or bills, or coins, and so forth, are very easy to count and to measure accurately. It helps to facilitate transactions far more so than in a commodity money environment. The next characteristic, limited in supply. A money system must accurately represent the value of all goods, services, and assets. And the last characteristic of a good money system is that it needs to be accepted widely. in the exchange for both goods and services. Well, it's now time that I need to give you a working definition of the money supply, particularly as it relates to the United States economy. The money supply is all the money available in the United States economy, and it's managed by the Federal Reserve Bank. This then leads to the following question: how much money is there in the United States economy? And the answer to that is approximately $15 trillion. And the $15 trillion breaks down into approximately $1 trillion in actual hard currency, the bills and coins that you're familiar with, and $14 trillion in virtual money. A few moments ago, I mentioned that the money supply is aggressively managed by the Federal Reserve. And in doing so, the Federal Reserve likes to break the money supply into three categories for measurement. And I'm saying this a little bit facetiously, they put fancy titles on the three categories. Not really. Here's the first category. It's called M1. It represents money that people can gain access to very easily and immediately. And there are two key points about this. First, M1 category is cash and assets that have what we call liquidity, meaning the ability to be used or turned into cash out of or from what we call demand deposits, short-term accounts such as checking and savings accounts. And that plays the biggest part of the M1 category, what is in demand deposit accounts. I've also found it helpful for some students to represent the concepts around our money supply through some pictorial. So I'll do that here, and we'll take our first category of measurement, M1, first. M1 includes our cash, our coins, effectively our currency, plus our virtual money that is in the checking and savings accounts of our society. And there's one additional piece to this. It's traveler's checks that are also related to demand deposits, like the virtual money. If you're not familiar with traveler's checks, it is still widely used around the world. If you don't want to take your debit card or credit card, which are also generally widely accepted around the world, with you for security and safety reasons, so that you want to travel with something that's very useful but not put at risk having your credit card or your debit card stolen, you can use traveler's checks. To get these, you simply go down to the bank, and based upon obviously the amount that you have in your demand deposit account, your checking and savings account, you can order up some traveler's checks. And the teller at the bank will ask you, in what kind of denominations do you want? Tens, 500s, hundreds, 20s, 50s, and the like. And they'll give you a book of traveler's checks, and the bank will charge you a little bit of a fee for that, a small overage. And the reason they do that is part of the advantage of using a traveler's check. In walking around overseas with traveler's checks, it's as good as having cash in your pocket. They're widely accepted in just about any country that has a banking function in it, and in today's world, the ones that don't are a slim few. And you can virtually go up to any merchant, pull out a traveler's check, and pay for something like you actually had cash. So why does the bank charge you a little overage? Well, if you happen to lose your traveler's checks, or if they get stolen, the bank will replace them immediately for you and get new traveler's checks into your hand. So it's a little bit of an insurance policy, if you will. These are the things that make up the M1 category. Now, we also add another little graphic here, and you'll see why this becomes important as we move forward in considering the other components or categories of the money supply. So let's let M1 be represented in this one circle up here to the upper right of the screen. So here's the second category of the money supply, and again, real fancy, called M2. What M2 is, is all the assets that are in M1 plus additional assets that cannot be immediately converted into cash. And in the study of economics, we call these other assets near money, meaning that they're close to being able to be turned into cash, but not very conveniently. So let's look at some examples of this. Once again, I'm going to use a graphical representation, in this case for M2. So let's start. M2, remember, includes everything in M1 plus this concept of near money. So what's included in near money? Well, money market funds. In addition to that, mutual funds. And let me stop right there. We're going to look at money market funds and mutual funds much closer in next chapter when we look at the financial system and financial products. But the short of it is, these are your investments in stocks, bonds, and the like for general purposes, but also, for example, in IRAs for retirement purposes that would supplement what you would get with Social Security, your personal savings, if you will. And also, the near money includes things like individual stocks that you might own, as well as other items such as your home, car, and other large assets. So why are these accounts, your money market funds, mutual funds, stock, and these other items called near money? And the reason for that is you cannot, in a matter of minutes, moments, or for that matter in these cases, a couple of days, turn these into actual cash. It takes time to sell a home. It actually takes time and a lot of paperwork to get your money out of accounts that you have for investment purposes. So it's this time factor here of how quickly you can turn something of value into actual cash to be used. Also, continuing on here with our graphical representation and using our circles, we have M1 as the center circle, and as I've just mentioned, M1 is part of M2, so we simply embrace the M1 circle in the larger M2 because we're including these additional assets. And here's the third category of the money supply. Following the progression, it's naturally called M3. And what M3 includes is everything that's included in M1 and everything that's included in M2 plus 3 additional things. The first is institutional money funds. Let me give you an example of that. These are large banks of money and investments that are for specific purposes. For example, the state of Arizona has for its state employees, including teachers, a pension system where it's continually contributed to out of people's paychecks. And that's a big pool of money that the state has somebody in charge, or groups of people in charge of managing and investing. So these are big pools of money that are used for different purposes, pension systems being one, that operate in our economy, making investments and helping grow our economy. The second example, or very similar to institutional money funds, are large time deposits, such as the money that goes into the Social Security fund, or that winds up getting paid into the Medicare, Medicaid funds. The last portion of M3 is actually the foreign currency operating within our economy that we have to account for, because those are legitimate currencies that have value. And as a matter of fact, the central banks, like the Federal Reserve Bank, actually exchanges currencies with other banks in other countries, central banks in other countries, sometimes to actually adjust money supplies. So all these are included in the M3 component. And continuing along on our graphic representation of our circles, here we have M1 inclusive of M2, yeah, M2 inclusive of M1, and then M3 embracing the other two categories of the money supply.